FY2025 quarterly results presentation. I'm joined today by Sylvain Collard, Chief Operating Officer. Hello and welcome everyone, and thank you for joining us for Sayona's June 2025 quarterly results presentation. I'm joined today by Sylvain Collard, Chief Operating Officer and President Canada, Dougal Elder, Chief Financial Officer, and Andrew Barber, who heads up Investor Relations. This was a milestone quarter for Sayona, one where we not only delivered record production at North American Lithium, but also improved our cost structure, achieved our best safety performance in almost a year, and progressed the transformational merger with Piedmont Lithium. Today I'll walk you through our safety performance, operations, sales and cost results, our exploration progress, and finally the steps we are taking to position Sayona, soon to be Elevra Lithium, for the future. Unless stated otherwise, all dollar amounts discussed today are in Australian dollars. Let me start with safety. I'm pleased to say that May and June were lost time injury-free months, which is a fantastic achievement and our best safety performance since September 2024. This outcome reflects strong field leadership, proactive hazard identification and reporting, and an ongoing focus on embedding safe behaviours across our workforce. On the environmental side, we progressed baseline studies to support a potential expansion at NAL. Importantly, no significant environmental concerns have been identified to date, which is a positive sign as we look to grow in a sustainable and responsible manner. Turning now to operational performance, it really was a standout quarter. Ore mined for the quarter increased to 361,883 wet metric tonnes, up 12% quarter on quarter, as we focused on improving ore availability to feed the mill. Ore process jumped even more sharply to just under 358,000 tonnes, up 24% on the March quarter. This higher throughput came alongside a record mill utilisation rate of 93%, which is 13 percentage points higher than the March quarter. This is a direct reflection of the reliability and efficiency improvements that Sylvain and our operations team have been driving over recent months. Lithium recovery was also at a record 73%, up 4% quarter on quarter, reflecting excellent operational process discipline and improvements in the plant. All of this translated into record spodumene production of 58,533 dry metric tonnes, up 35% on the March quarter. It's worth noting that even with this higher throughput, our concentrate grade remains steady at 5.2%, so we're increasing volume without compromising product quality. On the sales side, we executed well on our strategy to weight shipments to the second half of FY2025 when forward prices were more attractive. In the quarter, we sold 66,980 dry metric tonnes, up 148% compared with the March quarter. That resulted in revenue of $71 million, which is the second highest quarterly revenue result we've achieved since restarting production at NAL. Average realised selling price came in at $1,054 per tonne on an FOB basis, or $682 US per tonne. That's 8% lower than the March quarter, but still a strong result considering lithium index prices were down 15 to 20% across the quarter. Our forward sales program has proved its worth, helping us secure high revenue and achieve stronger price outcomes than the market benchmark. The cost story also reflects continued and sustained improvement. Unit operating costs on a tonne sold FOB basis fell 10% to $1,232 per tonne sold, or $791 US per tonne, reflecting the benefits of higher production and continuing efficiency improvements at NAL. On top of that, our unit cost of production dropped to $737 US per tonne. Combined, these improvements in realised pricing and unit cost of production costs narrowed the cash operating loss to just $55 US per tonne for the quarter, despite the weak pricing environment. In recent weeks, we've seen spot lithium prices improve, with spodumene pricing having recently touched levels of more than $150 US per tonne since quarter end before settling lower. So we're entering FY2026 with positive momentum on both cost and pricing fronts. Turning now to the balance sheet, we ended the quarter with $72.3 million in cash, down from $88.9 million at the end of March. This decrease reflects the reality of operating in a low-price environment, with operating losses at NAL due to pricing pressure, broader group operating costs, and non-recurring merger transaction costs. That said, we received $8 million in contributions from joint venture partners, which partially offset these outflows at NAL. In exploration, the focus has shifted from drilling to evaluation and resource modelling. We've now completed more than 268,000 metres of drilling across NAL and Moblan over the last 2 years, and updated mineral resource estimates for both projects are on track for release by the end of August. In Western Australia, we made progress at Mount Eden, particularly on its rubidium potential, and we signed a research partnership focused on rubidium processing. Work also advanced at Tabba Tabba and across other Pilbara lithium and gold targets. Finally, our merger with Piedmont Lithium is progressing as previously communicated. All regulatory approvals are now in place, and shareholder meetings are scheduled for the 31st of July. This merger creates Elevra Lithium, a premier hard rock lithium producer with a leading position in North America and dual listings on both the ASX and NASDAQ. Importantly, and subject to shareholder voting, the merger will also deliver $69 million equity investment from Resource Capital Fund, RCF, at a significant premium to the current share price, strengthening the balance sheet and providing the funding capacity to drive forward our growth initiatives. To summarise, we delivered improved safety performance with 0 lost time injuries in May and June, record production and cost reductions, progress on resource growth projects, and a clear pathway to completing our transformational merger and launching Elevra Lithium. Despite challenging lithium market conditions, our team's resilience and focus have positioned us strongly for FY26 and beyond. Thank you for your time today, and I'm happy to take any questions.
Thank you. If you wish to ask a question, please press star 1 on your telephone and wait for your name to be announced. If you wish to cancel your request, please press star 2. If you're on a speakerphone, please pick up the handset to ask your question. Your first question today comes from Austin Yun with Macquarie. Please go ahead.
Morning, Lucas and team. Just 2 questions from me, please. The first one is on the recovery, or was quite good at the 73%. Could you just please provide more color on that and how sustainable this high recovery rate is into the next financial year? And second, I will come back with the second question. Thank you.
Thanks, Austin. Look, I think I'll pass to Sylvain in a moment, but I think just probably a couple of overarching comments. I think the benefits and the improvements you've seen in the mill have been a sustained effort over really the last 18 months. There's been ongoing work around refinement for the use of collectors and how we dose and getting the right collector aligned with our ore type. So there's been a number of factors. I think, Austin, we'd like to be able to probably just string a couple more months together, but it's encouraging what we've seen in terms of performance. But I'll hand over to Sylvain, and he can give you a little more colour in terms of what the metallurgists have been up to.
Thanks, Lucas. So yes, you're absolutely right. So the focus on the team right now is mostly on the magnetic separators. We know when we optimize the operation of these 2 critical equipments, we can decrease, let's say, the loss in terms of recovery. So that is the first major point. The second one, like you explained previously, optimizing all the parameters related to the flotation, the collectors, and so on is making a huge difference. And then we're pairing that also with operators training, how to react when they see some specific outcome in the flotation and loss in recovery. So the operators has been trained, let's say, very, very focused on specific parameters by the metallurgist, lead by Charles Bousseau. So all these parameters all together has been reflecting the good recovery we had in the last quarter.
Austin, we've banked some of that into our FY26 guidance, which will be out at the end of August. But there's probably a little bit more that we just want to be able to really nail down. So we want to be known as a company that delivers on what we say we're going to do, and we want to be able to make sure that those elements are sustainable. But all the indicators are certainly positive of that being a sustainable outcome.
Thank you, Lucas. And just second question on the sales. Was there any kind of a slippage of shipment in this quarter, or was it just everything being kind of carried out to schedule? I had a kind of probably more higher shipments in this quarter than what's been delivered. But I recognize, you have achieved the full year guidance nevertheless, but any color would be helpful. Thank you.
Austin, no, it went according to plan. As you noted, our sales profile was back-ended in quarter four. So no, we delivered upon that. We hadn't seen any slippage in terms of shipments, and we finished the quarter with finished goods stockpile at just over 25,000 tonnes of stock.
Thank you for passing on.
Thank
Thanks,
you.
Austin.
Once again, if you wish to ask a question, please press star one on your telephone and wait for your name to be announced. We'll now pause a short moment for questions to register. Once again, if you did want to ask a question, please press star one on your telephone. Thank you. It appears there are no further phone questions at this time. I'll now hand the conference back over.
Thanks, Ashley. Just taking a couple of questions off the webcast. First question is, Larry Fink, the CEO of BlackRock, who started ESG reporting, has openly confessed the program was somewhat of a disaster and has been withdrawing these policies from their organisation. Why is Sayona still involved in measuring and reporting on ESG? It seems that it's a waste of time and effort administering these policies and costing the company money. Would you please comment, Lucas?
Thanks, and thanks for the question. Well, I think probably a couple of things just at the outset. Clearly, I think ESG, the pendulum has swung back from where it had been, but importantly, across different jurisdictions, it's quite different. Obviously, in the US, so the pendulum's probably swung further back. Australia, there's been probably some moderation, but not to the same extent. I think the other component as well is that those principles that ESG are founded upon around environment, sustainability, and social license and good governance are basic principles that we have got in our business in any case. So shareholders shouldn't be sitting there thinking that we're spending additional money on ESG. It's just good practice. And I can tell you, safe operations are productive operations. We need to be complying with our environmental obligations, so making sure that we're hitting those aspects is imperative. And then, obviously, social engagement with First Nations and so forth is critical to potential expansions and ongoing operations. So those principles really still stand the test of time, and we can certainly assure investors and shareholders that we're focused around where our expenditure is going. But the work that we're investing on around the ESG element are all very much focused around being able to enable continued operations, the successful continued operations at NAL, and also our growth prospects at both NAL and Moblan.
Okay, thanks, Lucas. I have a further question on, in particular, some historical short selling in the Sayona stock, which I might just take the question if that's okay.
Sure.
Firstly, I just want to reiterate that short selling in the Australian market is a legal practice. Whether we like it or not, it is something that is available. It is regulated to the degree that the regulators have set the boundaries. The company monitors it, but has no ability to influence it. And whilst it can be, it can be frustrating for shareholders to see that going on at times, unfortunately, from the company's perspective, there's not actually anything we can do about this. I think at the end of the day, I've been in the equity markets for 20-odd years, and those who've shorted ultimately have to buy it back. And so, you do tend to find that these things work through the market over time. So I think, you can be reassured that the company does keep a close eye on this, but any issues really are down to the regulator. Another question that we've now received is, what's the expected decrease in all-in sustaining cost when the merger's completed? Lucas?
Yeah, obviously we're going to see. So let me go back a step. We've identified synergies in the order of $15 to $20 million US as part of the merger, and we're on track to be able to deliver those. Been a lot of work done around the planning for the merger. So a number of those will be across, if you like, corporate headcount, corporate efficiencies, but then also operationally, the collapsing of the offtake agreement, and then also logistics as well. So there's really a broad spread across there, but we'd see in that sort of $15 to $20 million US annually being achieved through the merger synergies.
Thanks, Lucas. Ashley, there's no further questions from the webcast at this stage.